Hi, in this video we're going to be looking at business growth and decline. Now, um, this diagram here is of the business life cycle, and I'm showing it to you because this is something that we're going to be referring to quite a bit during this video as well, so it's important to become acquainted with it. Now we're going to be looking at each of those four stages in a bit more detail. So the first one we're going to be looking at is the establishment stage. Now, the establishment stage really is the birth of a business, and the biggest concern is to have a solid foundation on which to build on and grow the business. And one of the biggest challenges is to have a positive cash flow. You're a brand new business. You've put out a lot of money to start the business, high establishment costs as well. You haven't really got a customer base at the moment, so you really need to try and have a positive cash flow. Some other challenges are things such as having a very slow profit to begin with. You're not going to make $1 billion overnight. There's erratic cash flow, and you need to establish that loyal customer base. And there's a very high failure rate as well for businesses in this stage here because they spread themselves too thin too quick. They borrow a lot of money from the bank, or they put in a lot of money to start the business, but they haven't really invested, if you will, in a strategy to attract customers and keep them with the business as well. We're moving on to the growth stage now. And in the growth stage, this is where a business sees accelerating growth. It shoots up like a rocket almost. The business now has a customer base, and it's looking for ways of maintaining it and maintaining the cash flow with such rapid growth. They might want to open up a new store. You need money for that. And are you able to have a positive cash flow with two stores? And they also, while they've got a customer base, they need to keep those existing customers happy as well. Now, in order to continue growing, there are certain ways you can do it. Okay, and that's through mergers and acquisitions or takeovers. And there's three sort of steps in that as well, or three ways you can do it. You've got vertical integration. Now, what this is expanding to a different but a related production level. So if you go backwards vertical, you're going up the chain, it'll be a bakery buying a wheat farm, for example. So they've got a constant supply of wheat for their bakery. You've got forwards vertical integration, so you're going forward in the chain, which would be a bakery buying a supermarket. So they've got a constant place where customers can find the bread made at the bakery. You've also got horizontal integration, so this is moving side to side now. So merging with a firm that makes the same or similar products. So a bakery merging with another bakery to create a bigger bakery. And then we've got diversification, which is merging or acquiring or taking over a business in a totally unrelated industry. So, for example, a bakery buying a furniture manufacturer, for example. Once you've gone through that growth and you've got your customers, you then enter what's known as the maturity stage. Now, this is not to say that every business goes through each stage. A business may never get to the maturity stage. A business may never get to the post-maturity stage. They may fail in any of these stages. So this is in a best case scenario, I guess you'd call it, where a business goes from one to the next to the next to the next. Now, in the maturity stage, the business is very well entrenched in the market. Okay, they're a very well-known company. However, they could lose its energy. They may have been around for 10, 20, 30, 40, 50 years, and they start to lose their energy. So the profit starts to slow down a bit. Customers may see the business as being impersonal due to its size. It used to be a corner store where you go in and the owner will know your name. Now it's a company that's got 5,000 employees all over the country, and no one knows you personally anymore. So what they need to do is they need to restructure or reorganize the business to bring back some vitality. Now, following on from the maturity stage, we've got the post-maturity stage. Now, there are three ways that a business can sort of go when they're in post-maturity. They can either renew, they can decline, or they can continue in the same steady state. So if they continue in steady state, the business keeps operating at the level it has been during the maturity phase. So, just keeps going. It's happy being, impersonal. It's happy being, the same business it's been. It can go into decline. So falling sales profits eventually leads to business failure. Or it can go into renewal. So increased sales and increased profits due to new growth areas. They tapped into some new technology. They've developed a new product, or they've slightly augmented a current product, and they've been able to grow from that. What happens if a business does cease to trade? So, in terms of voluntary and involuntary cessation, what this means is involuntary, the owner ceases to operate the business out of their own free will or of their own accord, whereas involuntary, the owner is forced to cease business operations. Now, there are a number of ways that this can happen. So, we've got bankruptcy. Now, bankruptcy is the declaration that a business or a person is unable to pay their debts. Now, this is more likely to happen to sole traders or partnerships, now, because of their structure. Now, this can be voluntary, so the owners can declare bankruptcy, or it could be involuntary. Banks can step in and apply to the courts and have the business declared bankrupt as well if they haven't been paid for a certain amount of time and a certain amount of money as well. Now, for private and public companies, however, this is more likely to turn into voluntary administration. So in this scenario here, an independent administrator is appointed to operate the business in the hope of trading out of the financial problems, in the hope of being able to sell products, being able to cut costs in order to get out of the financial problems. Now, the term for incorporated businesses, which are your private and your public companies, as opposed to sole trader and partnerships, the term for them is insolvency, as opposed to bankrupt, which is used only for unincorporated businesses, so your sole trader and your partnerships. Insolvency means that the company doesn't have enough assets to pay its liabilities. So assets is what they own, liabilities is what they owe. So they don't have enough assets, enough good things to pay off its liabilities, enough bad things, basically its debts. Now, in involuntary administration, if the administrator is successful, the business may resume normal trading. Okay, it doesn't have to shut down after this, because they may actually be able to sort out the problems. However, if not, the business goes into liquidation. Now, in liquidation, an independent person is appointed to sell the business's assets in order to pay the creditors. So, liquidation leads eventually to the business ultimately ceasing to trade. Now, also with liquidation, a company can also be in what's known as receivership. However, under receivership, the business may not necessarily cease operating and shut down. In receivership, a receiver is normally appointed by a secured creditor, so a bank, and the court can appoint this as well. The bank might say, we're going to put in a receiver. They're going to take over the business's affairs in order to try and recoup as much money for themselves as possible, for the bank as possible. Once they've done that, they'll hand the business back to the directors to continue with the liquidation procedures, and then eventually cease trading. But at least the bank has gotten back their money somehow. And liquidation, as I said, does eventually lead to ceasing to trade. Receivership doesn't always lead to ceasing to trade. They might go in, they'll get the money for the bank, and then the receiver leaves, continue with the liquidation procedures. Now, the liquidation procedures could be both voluntary or involuntary. So the board of directors may say, look, we're going into liquidation. That's out of their own free will, and they shut down. Or it could be something that's appointed by a court or the creditors that say, look, you're losing a lot of money, we're not getting paid, we want our money, and we're going to do that by selling your assets, and then you're shutting down. In a nutshell, really. Um, so I hope that this brief video has given you enough information on how businesses establish themselves, how they grow, and how ultimately, unfortunately, they decline, and the processes around cessation as well. Thank you.